Okay, so we are talking about cash sales. Very brief. This is not an in-depth discussion of it, just some highlights. Once you get into a deal like this, it's probably a little bit more um, hurdle to jump through as a buyer than there is for a seller. Um, so for sellers, just real quick, for every sale, you're going to get a 1099-S as a seller. And this is for the IRS. It'll be reported to the IRS. You sold your house and they're looking for, did you make your $250,000 as a single filer on capital gains, or did you make $500,000 as a married couple filing jointly on capital gains? So that's what the 1099-S form is about. That sale, if it's all cash, it may be and probably is reported to the Financial Crimes Enforcement Agency. It's fincen.gov through Form 8300, which will come through the title company. They'll file that to let them know, hey, we had an all cash deal over here. And it's just to monitor large sums of money like that go through real estate to make sure there's no money laundering going on. If it's a 1031 exchange, you'll need a qualified intermediary. Anybody want to tell me what a qualified intermediary is?
Somebody that
Anybody?
holds the funds until you identify and close on another home?
Right. It is a qualified, it's a corporation, and they have to hang on to the money until you identify the next property and move it along. That's so that, because when you're doing a 1031 exchange, the investor cannot touch the money. I had one guy call, I got a house, I'm selling it, and then I'm going to buy another property. And when I started talking 1031 exchange and intermediary, he thought I was like, hocus pocus kind of talking, and thought I was trying to pull the wool over his eyes. I'm like, look, man, you're going to get dinged with taxes. And he just didn't want to hear it and got off the phone. So some owners of individual property, that they don't look at themselves as an investor when they have one property they're renting out and then they're getting all this boatload of money, and they don't understand why they suddenly have this big tax bill as an investor. But you'll need an intermediary, qualified intermediary. You got to choose a replacement home. There are deadlines involved. That's a 1031 class that David Robertson at Universal Title does. I'm just letting you know, in cash deals, these are some of the ways that you'll find it as a seller coming into the transaction, what that means. Okay. For the buyer, all cash, it means that you've got to have proof of funds in your contract. So, and if I say something that sounds weird or off or whatever, please feel free to jump in and talk. I'd be happy to entertain knowledge that I'm not aware of on this. But with the proof of funds, you'll hear, I need POF on that. And it's a statements with the account numbers. You black those out. You submit that with your offer the way that you would submit a lender letter. But you also may get a statement or a letter from the fund manager with the phone number for verification. That's my add-on, because it's great. They say international equity funds. Okay, I don't know who they are. I've never heard of them, but they got this statement saying, yeah, they got $1.3 million in the bank. They're buying an $800,000 house with funds. Great. I want to pick up the phone and call that person. So it's not just I've got this proof of funds letter and statement. You as the agent fiduciary, you need to nail that down. Is this true? When people send a statement of funds for cash in a bank account, I'm looking at the date. I remember getting one and it was like, it was like this. We were in August, but the statement was from March. Too long. I want within 30 days, because they can move funds around and use that to verify that they've gotten cash. But that cash may have been moved around. It may have been eliminated or something else. Other things with cash buyers, there's no lender title insurance the policy required. Could save you about $1,500 or so, depending on the price of the property. With cash, I would definitely have a title insurance policy. You just don't need one for the lender. Okay. And when it's all cash, it's like all your money's at risk. Okay. You want to make sure you got that title insurance policy. You surrender points to deduct after the sale. You don't have points when you're buying in cash, so you won't have those types of deductions available to you. No interest paid deductions for taxes. You don't need a lender letter, and possibly no appraisal. But with appraisal, if they want to have one, there is an appraisal with cash addendum. So you still have a form to fill out with that in the contract if someone's doing cash and they want to have an appraisal. Mostly cash. Now, this is kind of where I want to bring in Rob. I believe he's on the call now. But if you're doing mostly cash, what does this do for someone, a buyer that's got a lot of cash? They're buying 800,000, they're bringing 400 grand to the table. You need a lender letter, and you would still need a proof of funds for that to look at the evidence that you've got all the money necessary to do that. Hey, Rob, I'm going to toss this over to you. When you've got someone doing a really big down payment and they say they want to do that, I've got some things here. Maybe there are other items you would add.
Yeah, I think the biggest thing that I want to touch on, and stop me if I'm going in the wrong direction here, but a lot of these big cash down payments will come from family members, and how do you adequately season funds? So I will just express to you what the guidelines are. There's two ways to season funds. And this is with any kind of loan. This is with FHA loan, VA loan, conventional loan, jumbo loan. It doesn't matter what kind of loan you're doing. The seasoning is the money has to be in your account for at least 2 cycles of your bank account statements. So when we go out and we're looking in your bank account statements to see if you have those funds in there, I'm going ahead and I'm taking, okay, there's 1 month statements. Okay, there's no large deposits. There's 2 month statements, no large deposits. You're good to go. Now, so that's one way of doing it. There's a second way of doing it, according to the guidelines, is that you can send those funds, or your family member can send those funds directly to the title company. Okay, once we receive receipt that the funds came from that family member to the title company, we no longer that's sourcing it. You're good to go at that point. The other way, when you are trying to season funds for 2 months and you get it in for 1 month, but then you find the house that you want to move into, it makes it difficult, because then we have to go and prove source of funds from the donor who gave you those funds, and make sure they had the money. And you can go down a rabbit hole with all that. So that to me is the biggest piece right there, is just how do you transfer large sets of funds if it's coming from a gift, family member, sometimes friends. How do you season those funds and make sure that they're legitimate according to the guidelines?
Does that also include like just what I would say a run of the mill gift where they're giving like 15,000 or something like that?
Even $15,000, you stop. No, don't let it hit your account. A lot of people just go, oh yeah, they're giving me $15,000, and they have wired it from their family member to their account. It opens up a rabbit hole where we have to do a gift letter. We have to then go into the gifters' accounts, and nobody likes their bank accounts being looked at. Get a month worth of statements from that bank account and make sure the money was in there. But sometimes the person who gifted that $15,000, they transferred it from another account into that account. Then we have to go to that other account and look at the bank account statements. And so you can literally go to 4 different accounts on a small gift of $15,000, whereas a gifter just took that $15,000, sent it directly to the title company. We would not have to go look into their account. So
because the bank's not really involved in that now. The bank would be involved, but the buyer doesn't. You don't have to substantiate where'd you get this 20 grand from.
you don't have
last
exactly.
week.
Exactly.
Yeah. Another one on this one is I had one where a buyer was bringing funds in from another country, and boy, that was something. She was coming from Ghana, and Ghana did not have, at that time, Ghana did not have a branch bank in the US. So her funds had to go to another group, another country that did, and then they had to send it over here. And then it was a boatload of challenges. I couldn't get anyone from her bank to talk with me. So I finally got on the phone with my own bank. And at that time it was PenFed. I'm like, well, PenFed, they're international. They deal with this all the time. And the guy was very helpful. He said, oh yeah. Says, if it comes in a big sum of funds that goes to the Fed, and the Fed freezes it until they can make sure this is clean money. So it was very, the seller, kudos to them. They held in there. And we were able to get it done. But that seasoning of funds can be a big headache and cause everybody to pause. The challenge for the seller, they're like, what? Wait a minute. What are you doing? What do you mean they're looking at your funds? And they get suspicious on what's going on. So limits on how much from the 401k, can you talk to that, Rob, on?
Yeah. So a lot of people don't realize when you're talking to them, and this is good just to have in the back of your mind. Some people, I'll be asking questions, how much money you have in your checking account, how much money you have in your savings account. And they'd be like, well, we only have like $3,000 in our checking account. It's not going to be enough, for a down payment. It's not going to be enough for the closing costs. So I'll ask them, well, do you have any, 401ks, TSP money? And traditionally, if they've been working for a little bit, they do have some money in there. Yeah, maybe I have about $100,000. So on TSP 401ks, you'd have to go do research, but typically you can borrow up to 50% of your TSP or 401k up to $50,000. So those are the general guidelines for that. What I like about borrowing against a TSP or your 401k is that you're borrowing against yourself and not a bank. So you do have to pay interest on it, and the interest and the payment has to come out each and every month. However, you're paying yourself. You're not paying a bank, 7% interest. You're paying yourself. You're not taking the money out of the market. It continues to be in the market. And it's a great way to get some funds, if you needed $20,000, $30,000 for closing costs in the down payment. And that's one way of doing it. A lot of people don't even know that they can do that. And I like that people don't know that they can do that, because we don't want people taking money out of their retirement accounts to go buy a new Ferrari or take a trip around the world. We want them to do it for, an asset and income producing asset like real estate. And so that's the one time I'll be like, yeah, if we need 5, 10K, let's do that. And that's an easy thing. And it doesn't go against your debt to income ratio. It doesn't change anything about the loan. It's just an easy way to possibly get a little bit of extra money to get you into the home.
Okay. Any questions on that from anybody?
Yes, I have.
Go ahead.
Yeah. Rob, how much? I know that is not the 7%, right? Because from the TSP, you borrow from yourself, right? Not to the bank.
Mm-hmm.
Just give me a range. How much? What is the difference? Is a big range? Is a big difference between the bank and the TSP? How much do you see it?
Well, let's say your debt to income ratio was up at 50%. So let's say you make $10,000 per month, and you have a mortgage payment that's going to be $50,000 or $5,000. Okay, that's the limit that we can give you, 50% of whatever your gross income is. Now, if you had to go to a bank and go borrow another $20,000, that would take your DTI above that 50% level, and you wouldn't be able to qualify for the home. And so borrowing it from yourself is so much better. If you did a HELOC. So I think the last time I went into my own account to look at what the rates were, I think it was around like 8% to borrow against myself on a TSP. If I went and did a HELOC, the rates at the time were around like 10%. So it was actually cheaper to go borrow that TSP money than it was to go out and get a HELOC or some other, loan, personal loan of any kind.
What,
Okay.
could you define TSP? What's TSP?
Thrift savings plan. It's for most government workers
Got it.
or in the military. It's the same thing as a 401k. It's just called the thrift savings plan, TSP plan.
Rob, and I also have another question. Based on what I know from the TSP, when you decide to, let's say, take them the money before, unless you are 65 above, you normally, they charge 10% fee.
See, and so that's the biggest misconception, and that's why people will not go into their 401k is because they believe that you're exactly right. If you take money out of your 401k or your TSP account before you hit the magic age, 62, I don't know exactly what the age is, 62 or some and some change.
Yeah.
You will get penalized 10% penalty, and you'll have to go pay the income tax on it.
Right.
And so you don't do that. That's why you take a loan against it, and there's zero penalty, no penalty whatsoever. It's a loan. It's like you are the bank, and you're loaning yourself money from your own bank, and you're paying yourself back with interest.
That's a good question. If someone is going to closing and they're using cash, like you said, a HELOC or a line of credit based on the equity on one house to buy another house, and they qualify for that and everything, they're not going through the underwriting process. Is that really cash, or did they get a loan?
Well, that's what I was going to say. You were talking about a couple slides back. I was going to say, yeah, some people will go out, they won't qualify for a conventional loan, and they'll go get hard money from somewhere.
Yeah.
Okay. And they'll take that cash. And so then if you want to, funds, so to speak, that money will already be sitting in their account. Before it's all about how the hard money or whoever the lender is setting that up. On a HELOC, you already have that money sitting there. And so you would take that money out of the other house or wherever you're getting that HELOC from, put it into your account, then you'd show it as proof of funds, and then it wouldn't be considered a loan. But on some of the hard money lenders, you will actually have to prove that it's a loan.
So then on the timing of that, how many months or weeks should they try to line that up?
Just when you're ready to buy a home. I mean, usually if you have HELOC money, you can usually take it out the next day.
Okay. And how long does a HELOC take?
To do a HELOC, it's like a regular loan. You can usually get it done in about probably 3 weeks.
Okay.
And it just sit there. When you take money against your home and you do a HELOC, you can take, let's say you had a home that's worth $800,000. You've paid the mortgage down to about $400,000. You want to have a HELOC of $200,000. You can take that HELOC. One of the biggest mistakes on HELOCs, there's two different kinds of HELOCs that you can get. One HELOC is one where you can take the money out. You can take $200K out, but it's just sitting there and you don't have to use it. Okay. But then there's another type of HELOC where they actually are going to give you that $200,000 and you're paying interest on it the day that you get that money. I don't like that one because
whether you use it or not.
Whether you use it or not, it's like a regular loan, so it's not really a HELOC.
Yeah.
So
that's more of a cash out rather than a
kind of a cash out, but they've disguised it as like a HELOC product.
Okay.
So yeah.
All right. Good. Any other questions about the cash, bringing a lot of cash to the table? Anybody else? Any other financing questions besides this? I'm just, what I do here is bring a topic, but it's really whatever you guys want to talk about. I wanted to talk about cash on this one today. I just did a video on cash on my own channel. And so I think as buyer and seller agents, we just need to be aware of when someone says, yeah, I got cash, or I want to do with cash, or I'm about to get a cash offer. And, I like it. People think that cash is king. I said, well, cash is king when it shows up and when it beats out a loan. I've had cash buyers say, well, mine's cash. And then they want to come in $25,000 under list price. I'm like, well, your cash doesn't matter. The guy getting a loan can go up 25 grand. So what's the seller going to do? Give up their equity because yours is magically better? To them, when they walk away from the table, the cash does not give them any more value if you're not bringing as much money to the table as the guy getting a loan. So that's something to keep in mind. Anybody else?
Well, the one thing I would add to that, Anthony, is that the buyer getting a loan usually has a finance contingency, and so you got to take that into account.
Yeah,
And sometimes an appraisal contingency. So
True.
that's the way for the seller.
true. So we've got, and that's a really good point, Andy. So, and I'll start it off and maybe you can finish it up. You got the lender letter. You've got are you making, do you have the wherewithal, the credit, the credit application, the credit check, the lender letter, the, appraisal. And then a lot of times all the conditions. Oh, that property's got this, this, and this. You have so many hurdles to go through. No offense, Rob, but so many hurdles to go through when you have the loan that can sideswipe it. And that cash is like, they're saying cash. And you got a really bad deck on the back. That's okay. I'll take it. Whereas some loan programs may force the borrower to get that fixed. So that kind of thing. All right.